So welcome everyone to today's finance and profit audit. For those of you who don't know me, my name is Peter Czapp. I am co-founder of the Wow Company, and we're an accountancy practice that works with businesses typically between 8 and 80 staff. And this is what we do. We'll help you to build a beautiful business. And for those of you not familiar with our concept of beautiful business, a beautiful business is one which is led with purpose by people who really care. It's guided by a clear strategy and is soulfully grown. And I know, looking down the list of attendees today, there are many beautiful businesses amongst us here today. And my job is to help you build an even more beautiful business. And the way that I will be doing that is to help you build the foundations for profitable and sustainable growth. Because whatever mission you are on, whatever cause you are championing, whatever good you want to do in the world with your business, you will not get very far unless you have these really strong foundations in place and you have profit right at the center of your business plan. So that's what I'll be helping you do today. And the way I'll be doing it is giving you the opportunity to assess your performance in 20 key areas. And this is when you need to be at a computer screen so you can click some buttons, because what that will do is give you a report and give you the opportunity to work out where you need to take action. So these 20 areas we split into 3 sections. First of all, we'll be looking at your infrastructure. So do you have the right people and systems and technology in place to ensure that you have a robust finance infrastructure in place? Absolutely essential at any point in business, but particularly important when we're going into more challenging times. So we'll be looking at your finance infrastructure. We'll also be looking at your reporting. We have seen consistently that the businesses that measure more metrics more often perform better. Every time we've studied this, we've seen this correlation. So it's really important that we have information at our fingertips to allow us to make the right decisions for our businesses. And again, important in the good times, especially important when we enter more challenging times. We'll also be looking at profitability. And this is a topic I know you're passionate about. I am too. I've been talking about it for nearly 20 years. I'll keep talking about it. And there's always stuff to learn here. There's always the next level. And I encourage you to think about what that is for you. As part of today, I will be sharing what high performance looks like. I'm really pleased to be joined by my colleague, Dan Arhin. Dan is an account director at the Wow Company and has worked with hundreds of clients over well over a decade now with Wow, and has helped them to build their beautiful businesses. And along the way has seen what high performance looks like in all of these areas. And we'll be sharing some really interesting case studies to help you raise your game. What you'll leave with today is a prioritized action plan. And this is the bit I'm really excited about. You'll leave with your 20-point assessment and you'll be able to see exactly where you're performing well. And you'll also be able to see where you have opportunities to improve. There's always the next level with this. You know, the beauty about these sessions is there's a wide range of businesses that come to them. So we have some small businesses and just beyond the startup stage, and we have some businesses larger than 10 million with us today. And what I would say to each of you, first of all, the smaller businesses, if you find yourself scoring low, don't be disheartened. This is a journey, and just work out what you need to do next. And if you're further up the scale and finding yourself scoring pretty well, my challenge to you is to work out what the next level is for you. You won't be doing this perfectly. Like, we're not. I can tell you that now. If we scored ourselves on this, we haven't nailed every single section. But the key is to work out what is it that you can improve and what do you want to do about it. So there's always the next level. So have a think about what that is for you. As I mentioned, if you have any comments or further thoughts, please share them in the chat. But if you have any questions that you want answered by me or Dan afterwards, then please use the Q&A functionality here in Zoom, and we will stay behind, as we always do, and for however long it takes to answer your questions. So it's one of the perks of turning up live. If you're watching this back as a recording, if you have any questions, then you can email me and I'll do my best to answer them. So on to the bit you're all here for, your finance and profit audit. We're going to share a link in the chat that you can go to now. So if you go to wowco.uk/audit, it will get you here. And then what you need to do is enter your details, and that will allow us to send you a copy of the report afterwards. So the exciting bit, let's hit start and get cracking. Now, the first thing to say about this is it's really important that you stay with me. Don't rush ahead. I know it's tempting to see what's coming up, but it's going to mess up the whole journey for you. So stick with us. I will guide you through each question, and give you some information that will help you answer each question correctly. So first up, infrastructure. We're looking at whether you have the right people, technology, and processes in place to grow. So first question, forecasting. So do you set meaningful targets for all areas of the business which your team engage with? So first of all, I will show you what one looks like here. So for each section, we're going to be scoring ourselves 1 to 5. So I'll show you what a low score looks like here. So what one looks like is what a spreadsheet I got through from one of our clients years ago. And it was just before we started working with them. I said, what is it that you do when it comes to forecasting at the moment? I said, oh yeah, we've got a really good business plan. So I said, okay, send it through to me. And in that business plan, it just said, so they were predicting, I think it was something like, well, I think it was 3.6 million revenue. And for revenue line, they just literally had 300 grand a month. They just extrapolated it out across the months. There was absolutely no thought had gone into that forecast whatsoever. No thought as to where that 300 grand a month would come from, how much would come from existing clients, how much would come from new clients, how much would come from large projects, medium projects, small projects. For the new clients, they hadn't sat down and thought out what the average value would be, their conversion rate, their pipeline would need to be. There was no thought whatsoever had gone into this. There was no thought around the peaks and troughs of their business. And certainly when it came to the costings, there was also no thought around, well, okay, what resource are we going to need to deliver this? And of course, you know, that's not a smooth curve. It's lumpy. When you hire someone, the costs go up by a chunk. There was no thought around the budgets in each area. And I think the key message here is there was no thought around the forecasting. So Dan, I'd love for you to just share with us a little bit about what you see 5 out of 5 looks like in this area, because I know you've got an interesting story about what one client did.
Yeah, no problem at all. So there's an agency that I work with, a creative agency up in the Midlands, and they have a really robust methodology in terms of their planning each year. And I guess it's almost the opposite of what you've just said there, Pete. So what happens is the finance team meet with the different revenue generating areas of the business. So in this case, there are different teams. There's a development team, a creative team, strategy team, and they meet with these teams together with the head of new business. And they start with looking at where they currently are. They look at the account management plans for their key accounts. They look at where they can grow their key accounts in the year ahead based on the understanding they have of the issues that they're trying to solve for their clients. And then they also look together with a resource plan for each billable area of the business, what they can do over the next year. And that's broken down into the big clients, small clients, medium clients, what they're going to do from a new business perspective, but also from an account management perspective. Once they've got that and that feeds through up to the top line revenue, they always aim for 50% gross profit. And they look at gross profit by department on this. And then what's interesting is, as well as looking at the billable areas of the business, they also consult with the team leads of the non-billable areas of the business. So once they've got their top level revenue, they'll then look at, okay, in order for us to achieve that number, what does our project management team need to look like in order to do that? In order to achieve that number, what does our client services team need to look like? What does our HR and recruitment costs need to look like? What do our operations look like? And they go through this process with each team leader so that the team leader in each of these teams are fully engaged and on board and actually creating these numbers. And then if there are any kind of specific costs which are quite considerably higher than the finance team were expected, then the team lead is expected to come forward with a business case to justify that expenditure and talk about why it's required and how it links to the overall strategic objectives of the business. And then by engaging those team members throughout this process, it means that they're fully engaged throughout the year as they track actual versus budget on a monthly and quarterly basis.
And that sounds like a pretty full-on process. How long does it take start to finish?
Yeah, so for this agency, it is robust, and I would say it is probably a 3-month process. So they are a March year end, and the finance team get together in December, and then they start to meet all the department heads in January, so that it's ready just before the start of the next financial year.
And just to give us some sense of scale of this, how, in terms of turnover, what's the turnover of this business?
This is a £4 million agency,
Okay.
4 million revenue, fee income agency.
So for that size business, you can see that, you know, this is absolutely the right way to go. If you're a £1 million business, then there's a version of this for sure that you need to think about. So have a think about what's proportional for you at your stage of growth, and then score yourself in that area. So obviously, if you don't have a forecast for the year ahead, you're going to give yourself a 1. If you're doing something like this, or the version of this that Stan describes that's appropriate for your size of business, then you give yourself a 5. And if you're somewhere in between, then obviously score yourself accordingly. Once you've scored yourself in that area, you can click the next button and we move on to the next area. So this is review discipline. What we're looking at here is, do you regularly and consistently review your progress against these targets? Because there's one thing actually setting the targets and going through all that effort to create the forecast and engage with your team. And the key part to that is engaging with the team. There's the next part is, okay, well, how often do you review back at progress? And what 5 out of 5 looks like is, well, every single month we have a meeting with the heads of departments that we review our progress, we look at where we're ahead and behind, and we take actions as a result. And those meetings are booked in, they never get missed. We always review that information. That's what 5 out of 5 looks like. Obviously, if you're not doing anything at all, you're down the bottom. But there's that bit in between, which is we can't kind of do it, or maybe we start the year with good intentions, then we get busy in it and it drifts off. And this is where the discipline comes in. This is the difference between those businesses that really excel in this area and reap the rewards, by the way, because this isn't just an exercise in doing this for the fun of it. By being disciplined and regularly checking back, you're able to correct issues a lot sooner. You know, we've all been in that situation where suddenly an issue occurs and it's a huge issue straight away. Well, that huge issue was a smaller one, a lot further down the track. And if you can identify those small issues, correct them, they don't become big issues. And that's the key to having review discipline. So score yourself out of 5 in that area, and we'll move on to the next section. So commercial terms. So again, this is all about setting yourself up for success. We're looking at, do your contracts and payment terms ensure you have, or ensure you negotiate favourable commercial terms with your customers? So well, first of all, let's look at a lot of people here today will be service businesses. We work with a lot of agencies and consultancies, and those of you who swap time for money and work on a project basis will be obviously issuing large invoices for projects or agreeing projects over a period of time. And the first thing that you need to do is look at how much you're billing up front. So we ran some research recently that showed us that the top performing businesses are asking for at least 50% upfront for all project sizes, even those in excess of $250,000. So that was really interesting, that no matter what project size, the top performing businesses were asking for at least 50% upfront. And certainly for the smaller ones, they were asking for it all upfront. So have a think about how much you ask up front, and also have a think about how much you leave for the end, because certainly you do not want to be leaving a large amount of money at the end. It's really important that you bill throughout the project. It's important that the billing is matched to the work, and that you bill ahead of time. You bill in advance. Don't bill in arrears. This absolutely drives me nuts. And in terms of setting yourself up, you're setting yourself up for failure. If you're billing in arrears, then it's not a good place to be, certainly not from a cash perspective. You've done all of that work, then you send the bill, and then you've got to wait to be paid. It's absolute bonkers. So please bill up front, bill as much as you possibly can up front, and check your payment terms so that you're not leaving a large amount at the end. Now, that's your billing. Then we need to look at your payment terms, your invoice. And far too many businesses are getting paid 28 days or even 14 days. It should be a lot quicker than that. Now, I know it's tough negotiating with larger businesses, procurement departments, but this is about how you set yourself up for success, the infrastructure. If you start off with our standard being 28 days or 30 days, that's your starting point for negotiations when they come back in and say 90. So you need to say, look, it's payment by return. Most of our clients pay by direct debit. Now, large businesses are not going to pay by direct debit, but can you get them closer to payment by return? Can you get them to 7 days? I know a lot of businesses have said they have managed to get 7 or even 10 days with big corporates, big corporates, simply by saying, look, it cost us money to do this. If you're going to pay us over 90 days, we're going to have to charge you the finance fee to for that privilege. So pay by 7 or pay a premium. And look, I know it's difficult negotiating with procurement departments, but you've got to set yourself up. You've got to have the right foundations in place. And the other thing to think about is then how well you negotiate, right? A lot of people just cave in. They're so happy to win the deal. And I've interviewed a few heads of procurement recently. And whilst their job is to get the best deal for the business, what I found really interesting about those conversations was a few things. First of all, their job is to get the best deal for the business. The best deal doesn't mean the best price. It's the best deal. They're trying to get the best people into their organization to do the best work, to get the best outcomes. That is how they get bonus, the best business outcomes. And if they're bringing in great suppliers doing great work, and the prices are reasonable, then they're really, really happy. The other overriding thing here that we need to remember when dealing with procurement departments is they're human beings. And it's really important that we treat them as human beings and get them involved in the negotiating process as early as possible. And I just want you to have a think about, first of all, how well your contracts and payment terms set you up for success, and then how well you negotiate. If you're sat there thinking, yeah, I've got really robust terms, we build loads up front, our payments are by return, and we're excellent at negotiating terms with procurement, you're 5 out of 5. If you're sat there feeling not quite so smug, then you can score yourself accordingly. But hopefully a score pops into your head and you can move on. Now, we all know how important cash is. And what I want you to think about now is how good you are, not just at collecting cash, but monitoring your cash position. So look, if you're sat there thinking, well, all my clients are direct debit, never have any cash flow issues, put yourself a 5 and you can move on. But for most people, collecting cash, particularly for large contracts, provides an overhead, an element of workload. So it's really important that you have the systems in place to look at this. I think every single week you need to be looking at this, and as well as making sure that you're taking the actions to get the cash in. There's simple things you can do, like for large invoices, you can pre-chase, phone up the purchase ledger department. Did you get the invoice? Is it the right amount? It's got the right information on it. I know a lot of the times it's automated systems, but then you can see the stage you're at in the process. You can see if there's any issues and get ahead of the game. Don't just ping the invoice in and then leave it till chance, wait till the payday to see whether the information is correct. Do your diligence up front. And then make sure that you are taking action every single week with those that have just slipped behind. Make sure you're reviewing your debtor days as a whole. Make sure you're reviewing the impact of whether you get paid or not certain invoices on your cash flow. Some people won't need a cash flow forecast, and there are plenty of businesses that are cash rich, they've got money in the bank, and over time they've got this so good that they don't need a cash flow forecast. But if you're not in that position, does your forecast, is it robust enough to give you the information you need to make decisions? That's the key question here. So again, you're going to have an inkling here. You're going to have a feeling in your stomach. Either you've got this absolutely nailed, or there'll be this feeling of nervousness about what lies ahead, because you might be sat there thinking, okay, I can sharpen up in this area. I could definitely get better at chasing debtors, definitely get better at visibility of my cash situation, and I'm going to score myself low. So whatever you score, then just enter it, and we can now look at the next area, which is expertise. So a friend of mine described running a business and the expertise you need, particularly the financial expertise you need as it grows, in a really interesting way. She said that when I first started off, I could run the numbers of my business just in my head. I had the key numbers in my head. That's all I needed. And then as it grew, I started to need to write them down on a bit of paper. And as it grew a little further, I needed a spreadsheet, and then I needed a few more tabs on that spreadsheet. And then I needed the whole technology in place. And then I really needed some help. And I guess it's looking at your own level of numeracy and level of comfort with the numbers, and then looking at the stage of business that you're at and saying, okay, given where I'm at, given how comfortable I am with numbers, have I got the right expertise around me to not only for where I am now, but for where I want to be in a year or two? Have I got someone who has the experience of guiding a business of this size from where we are now to where we want to be in 2 years? Financial expertise I'm talking about, because as your business grows, it does get more complicated. Things that you hadn't even anticipated, you're going to have to deal with. And it's really important that you've got the financial expertise around you. Now, that might be in-house resource, or it might be, you know, your accountant or your outsourced finance director. It's something that we do for a lot of clients who need that expertise, but haven't, you know, they can't justify a full-time FD. Well, you can tap into that service with us. You can tap into all levels of financial expertise and just pay for the bits that you need. My question to you is, are you sat there thinking, oh yeah, either I've got this sorted myself, or do you know what, I've got a brilliant outsourced FD that I use and they come in once a week or once a month to offer me guidance on this. I've got a brilliant bookkeeper who's absolutely superb, who's worked with larger businesses. I can see they're giving me the intelligence that I need that's beyond where I am now. You're going to score yourself 5 out of 5. But if you sat there thinking, do you know what, I'm either doing this myself, or the people that I'm asking to do this only work with businesses of my size or smaller, I don't think they've really got the expertise to guide me through what's coming next, then you're going to score yourself low. So whatever score you come up with here, then pop that down. We're now going to look at technology, and I mentioned spreadsheets earlier, but you'd be amazed at how many businesses we come across that are, you know, still running their businesses on lots of tabs, on lots of spreadsheets. And you know, there's technology available these days that will give you the information that you need much quicker and will allow you to make huge efficiency savings. So basically, you're going to score yourself low here if you're either not using technology at all, or the tech you're using isn't joined up, isn't talking to each other, isn't crucially giving you the information that you need. You're also going to score yourself low if you have lots of tabs or lots of spreadsheets and it's hard to get the information that you need. The utopia here is, you know, you've got a few reports that you can run at the click of a button that are accessible by all of the people that need to access them across your business, and everything's just working smoothly. Everything's talking to each other. It's all in one place. None or hardly any spreadsheets in your business. That's the acid test of 5 out of 5. So again, give yourself a score and move on. Complexity and cost. I think one of the final sections of infrastructure here. Are you running a lean, cost-effective finance function without complexity? So it baffles me how complexity just seems to accumulate. People seem to add complexity without ever taking it away. And this particularly is the case is if you've been in business for a while, there'll be reports that you've always run, that you keep running, systems that you've always operated that you keep working in. And the greatest example of this, we do this thing called a finance and systems audit, where we go in to businesses that have been going a while, that have a sense where they're pretty complex. You know, a really good telltale sign is lots of people in your finance team. If you're I don't know, let's say a £2 million business and you find yourself with 2 or 3 people in your finance team, that's way too, something's wrong. And we can go in, and one of the things we tend to find is we'll ask people what reporting they do, and we'll get an answer saying, well, yeah, we spend, I don't know, 3 days each month producing this monster spreadsheet, and it's got 28 tabs. And we say, well, why'd you do it? So, oh, well, we send it to the board. And then we asked the board what they do with it, and they said, no, we only use this one tab here. And they said, why all these other ones? We said, oh, we just assume they've been created for someone else. And everyone's assumed that this is being created for someone else. Meanwhile, the finance team are working their socks off to try and create this. No one's looking at this. It's simply not important. And this has just crept up on them over time. Little by little, they've added and added, and they've never taken away. And if you suddenly find yourself thinking, oh, hang on a minute, maybe I've got a bit of a bloated finance function. Maybe I'm spending a disproportionate amount on my finance. It's overly complex. It's not lean. Then you're going to score yourself low. Alternatively, you know, you might be looking at this thinking, do you know what? I've got this nailed. I've got a really good team. They're lean and efficient. I don't pay over the odds for this, in which case score yourself a 5. So that is the infrastructure section done. And at the end of this, you will get your score for infrastructure. Now, onto reporting. key question, do you have the information you need at your fingertips? So first up, accuracy. Do you trust the numbers you're presented with? Are they right first time, every time? If you've been in business a while, you know that feeling of being presented with numbers that just don't feel right. It's really hard to explain, but you just intuitively, you look at them and you think, hang on a minute, this doesn't quite stack up. And that just erodes your confidence in not just those numbers, but pretty much any numbers you see. So this might not be an issue for you. And if it isn't, if you sat there thinking, do you know what, I always get accurate numbers, score yourself 5 out of 5. If not, then a low score for you. Next up, we're looking at speed, how quickly you get that information. Accuracy is one thing, but speed's another. And if, again, what 5 out of 5 looks like here is you are getting management accounts. Well, first of all, you're getting the key information you need in real time. You can click a button and see where you're at in real time. But certainly your management accounts are getting to you no later than within the next month. So that's a really important definition. You don't have to wait longer than a month for your management accounts, because let's be frank, they're pretty rapidly out of date after that, and it prevents you from taking the action you need. So how quickly do you get information you need? Again, quick score out of 5 for that. And this is one I'd be amazed if anyone scores themselves 5 out of 5, because there's always a next level for this, which is the quality of information. And what I mean by quality is, do you have the detail that's required for your stage of business? And it's the detailed analysis. So for example, if you're a service business, can you split your profitability by client? I know you could probably, well, I don't know, can you even show me revenue by client as a league table, but can you show me profit by client? Because they're two very, very different things. Just because someone delivers loads of revenue doesn't mean they deliver loads of profit. Can you show me a league table in your business right now for profitability by client? If you can, that's pretty good. Can you show it to me by product or service? So again, for all the products that you sell or services that you offer, are you able to see the level of profitability right now and historically? I remember an agency that we worked with that did two things, very simple, web design and SEO. They were reasonably profitable as a whole, but as soon as we split those two things out and showed them the level of profitability for each, they realized they were making no money on their web design, zero, broke even. They made all their money in the SEO, and they made a very simple decision that day. We're not going to sell another web build unless it has an SEO contract assigned to it. So do you have the quality of information you need? Are you looking at things like your reliance on a single client? So in any period, how reliant on you on a single client? What happens if that client left? Do you have the detailed analysis you need to drive your business forward? A score out of 5 for that one. Now, most of the information you're looking at in your business is retrospective data. It's a historical record. Even, your accounts, even your management accounts, they tell you what happened last month. Your sales figures, your cash in the bank, these are all historical records. They tell you what has happened. Cash in the bank is a really historical record. It tells you everything that you've sold and delivered and finally being paid on before it eventually lands in your bank. Now, there's 2 levels above that. One is real time, one is predictive, and we'll look at real time now. So real time data are metrics that show you what is happening right now. So if you're a product business, maybe selling online, then an example of that would be, say, your sales today. Your sales today is what's happening right now. If you're a service business, it might be your live project reporting, the projects that you're working on right now, whether you're ahead or behind in terms of the profitability of those projects. It's real-time data. And what a lot of businesses do, they get caught up in the retrospective stuff and don't have enough real-time data. Are you measuring the metrics that show you what is happening right now in your business to allow you to course correct? Again, if you are, give yourself 5. If you're not doing any of this, it's a 1. It might be somewhere in between. Now, next level up is predictive data. So these are metrics that give you very early indicators of your future performance. So if you think about everything that goes into a sale and issuing an invoice, well, what comes prior to that is a whole load of metrics that give you an indicator of whether you're going to get that sale. So it might be the average client value and the conversion rate, and the number of proposals that you've issued. So proposals by conversion rate, and then the length of the sales pipeline, and the average value is going to give you an indication of the invoicing that's going to come further down the line. But there's something even before proposals, which is sales calls. And you're thinking, well, maybe that's an early predictive data that we can measure. Of course, many of you will, but there's stuff before that and before that. So what comes before sales calls might be, well, new conversations. And then before that might be people added to our database, or whether that's your email or interactions on social, or networking events I've attended. It's all these very, very early indicators of success that show you what's going to happen in the future. And if you're not measuring them, then the future is just going to hit you flat in the face. And this happened for a client of ours. In fact, here's the crazy thing: they were measuring them, but they just weren't paying close enough attention to them. So they had worked out in their business that a really key indicator of success for them were number of networking events they attended, and new people, new conversations. And they had, the two directors had specific targets that they set for each of those metrics, and they monitored them each week. So every single week they had to do this. And there was one particular week, well, a whole month actually, where not much of this happened, not much networking or new contacts were made. And that was when one of them got married and one of them had their first child. And in that month, sales were good. And in the next month and the next month, because they had a 5-month sales cycle. But in month 5, sales dropped off a cliff. And that created some real challenges in that business, because they said we didn't see it coming. Well, of course, if you go back, look at that month and see a big fat 0 in terms of activity, you could have seen it coming. And now they pay far more attention to those early indicators. They do not miss a month. There's no more marriages or children being born in that business, because they make sure they hit that number every single month, every single week. So are you measuring the very, very early indicators of your future performance, of your future success? What more could you do on that front? Again, a score out of 5. And finally, in this section, I just want to talk about dashboards. So dashboards, we've seen for clients, have had a transformative effect on their ability to visualize their key objectives and their performance against those objectives, and then share them with their team. And Dan, you've got an interesting story about a client that brought this to life and did it really successfully with their team.
Yeah, absolutely. A business that I work with, who on the face of it, we're doing really, really well. So fundamentally, the revenue growth was strong, gross profit and gross profit by department was really good, and operating profit was strong. But the one area that they struggled with at that time was cash, because their debtors were an absolute mess. So they had a really, really difficult time, and the directors had a conversation with each other, and they decided to be really transparent and open with the team. And they talked about, you know, the best way of communicating this, because they didn't want to create anxiety and stress amongst the team. So it's a really funny conversation, because they started talking about Star Trek to me when I was talking to them about this. And they talked about how they were talking to the team about how their scanners needed to be efficiently working. And by that, they meant having quality reporting and getting the right reporting at the right time. They then talked about the Klingons attacking, and the Klingons attacking was the actual cash flow issue itself, and the gap that they were trying to close in terms of cash flow. They then talked about sick bay, and sick bay was the actual debtors challenge itself, and the level of debtors that the team needed to chase in over the next month. And then they also talked about arming phasers, and that was going on the attack. So that was contacts that had gone cold, or clients that they weren't working on projects with, and looking at what they could look to bring in over the next few weeks. And the interesting thing with this, I caught up with the directors a couple of weeks after they had talked to the team about this and created this dashboard with these different areas, which was literally a Starship Enterprise with the different numbers that they were updating. And it had a really, really strong galvanizing effect with the team. The team genuinely came together and worked through this, and were really, really engaged in trying to help the business get through this. And I just thought it was a really, really interesting way that the directors came to think about, okay, what are we trying to do here? We need to try to make sure that we don't increase stress and anxiety on a situation that can be quite difficult, and we want full engagement and the team to rally around each other. And by communicating in that way, they absolutely did that, which was fantastic to see.
I think it's just a really important reminder that whilst there's lots of numbers in all of our businesses, Our job is to make sense, or to work out which ones are going to make the biggest difference, and then to engage our team in the pursuit of achieving those numbers. So definitely telling stories, reducing them down to the key metrics on your dashboard is really important. It's a really great reminder of how to really engage a team in this. If you do that really, really well, maybe you could be a fan of Star Trek and do a similar version, then give yourself a score out of 5. If you're sat there thinking, well, do you know what? We don't have that visibility. The numbers are hidden away. They're on, all sorts of in different systems, and we don't give that team that visibility through a dashboard, and we certainly don't communicate it well, then it might be a lower score. So hopefully a number there. Just to make a point as we move into the final section on profitability, these little title pages, you don't need to enter anything there. You just need to hit the next button. So just to make that clear. But we're now going to look at profitability, and most of the questions here do relate to service businesses. There's some that we've able to adapt to those that are not service businesses, but a lot of them relate to service businesses. So if that's you, you're in the right place. So I want to talk about your profit sweet spot. And so the profit sweet spot is the products or services that make the most profit for you, your business. And first of all, do you know what your profit sweet spot is? And are you targeting that at the expense of, I'd say, other products and services, to ensure that your most profitable products and services are being sold? So just a little example of this. We've seen over the years that there is a correlation between project size and profitability. By and large, the larger projects you tend to work on, the more profit that you tend to make on those projects. That has been a correlation that we've seen consistently every time we've surveyed service businesses. And but it might not necessarily be the case for you, because I remember this is the thing around sweet spots. Chatting to a business, a creative business. So they were an agency, and they had worked out, they said, look, our sweet spot is digital transformation projects. So they'd identified the particular service line between 20 and 50K. She said, look, anything less than 20K is just not worth getting out of bed for, but anything more than 50, 60K, and I don't know, it's just too technically complicated for us. I know it's not for other people, but for us, our capability, we've just been burnt before. So actually, you give us a project between 20 and 50K, digital transformation, we're awesome at that. And over time, what they did, they added certain niches. So digital transformation projects for the travel and tourism space, digital transformation projects for retailers, and they started to add very specific niches and get even more profitable with a specialist product at a specialist market and a very focused budget as well. And I'd encourage you to think about how well you've defined your profit sweet spot. Do you know for sure empirically which product or which service makes you the most money, and are you targeting selling more of these? Again, a score out of 5 for that. We're now going to look at pricing, and this is a huge area. I could literally spend all day or week talking about pricing, but the reason it's important is it's one of the key determinants of your profitability. Again, there's a correlation between what you charge and the level of profit that you make. And the question here is do you regularly increase prices? Now, this has always been important, but when inflation is running in double digits, then it's exceptionally important that you are regularly increasing your prices, and you have systems in place to do that. You're not afraid to do that. It's written into your contracts, and you're regularly increasing those pricing with clients. And I've heard so many stories recently of people who've been really nervous about having this conversation, and actually it's all turned out well. You remember, the alternative is, if you don't increase prices, you might keep clients, but they're going to be unprofitable clients because your margin is going to get squeezed, and it's getting squeezed at a faster rate than ever before. So it's really important that you do that. It's also important that you price based on value. And by value, I mean, it's not just your hourly rate. It's actually thinking about what is the value to this client and matching the price you're charged to that value. And when we ask our question in the various benchmarking that we do, the businesses that perform the best are those that price based on value or price based on performance. And I just encourage you to think about how you can maybe break the cycle for sort of charging purely based on an hourly rate. Finally, I give you some encouragement to use 3 pricing options. Again, whenever we do our research, those that give 3 pricing options have a better conversion rate and they have higher project values and therefore profitability. So if you're only giving 1 pricing option, you're giving the client the opportunity to go and compare your quote to others elsewhere. Now, they may do that anyway, even if you give 3 pricing options, but there are plenty of reasons why. And if you read any of Blair Enz's books, or if you listen to any of his podcasts, you'll know what those reasons are, why 3 pricing options will help you maximize deal size. So if you're doing all of those things, it's a 5. If not, it's a 1. But Dan, you might have some additional insight into what some of your clients have done, because there's lots of different ways to do this. What do the most successful ones do?
Yeah, so lots of businesses kind of ask the question or look for kind of what is that silver bullet when it comes to kind of increasing profitability. And the reality is in business, there are very few silver bullets, and it's all about doing the right things consistently. But this is one of those few areas where a disproportionate impact can actually happen as a result of making change here. And the top performing businesses, you'll see it's what you talked about in terms of those 3 pricing options, and specifically anchor pricing. And anchor pricing, effectively what you're looking at doing is offering 3 options. 1 option in and around a client's budget, a second option slightly higher than that, and then a third option significantly higher, which makes the middle option look a lot more reasonable. And there's a development agency that I work with who basically design and build websites, and their sweet spot was £20,000 websites, and they used to build these websites and they didn't provide any other options. So a lot of the time their prospects would go elsewhere to compare, and then they implemented anchor pricing, 3 pricing options. The bottom option, they actually nudged up from 20,000 to 23,000. Then they had a mid option at 30,000 and top option at 70,000. At this time, before doing that, their gross profit margin was in and around just over 40%, 41, 42% at that time. And then over time, once they had these 3 options, their gross profit margin actually increased to just shy of 50%, and their average deal size increased to just under £30,000. And what you said about the conversion rates actually rung true for this client as well. Their conversion rates increased as well, because by offering the different options, they were actually letting their prospects know more of the different products and services that they had to offer, and prospects were going to talk to competitors less than they did previously. So it made a really, really big impact on gross profit and operating profit. But just lastly, another beautiful thing happened here, whereby what happened was, when looking at that anchor, that top option, in this case, in this example, that £70,000 option, you're kind of looking at ignoring budget. What are all bells and whistles? How can we absolutely maximize ROI for this customer? And what happened was, loads of collaboration started happening throughout the agency to actually think about, what does that look like? In order for us to maximize ROI, what does that look like? So you had this fantastic teamwork and collaboration, and actually looking at these higher value services, which increase the teamwork for this business as well.
Fab. Really good case study there. I'd encourage you to do that if you're not doing it already. Mark, you asked a question about how regularly is regularly, and it's a really good question. There's 2 answers to this. I'm going to give one answer for your existing clients, the ones that you are already billing, and one for new clients, new prospects. So for your existing clients, I think reviewing it every year, having a formal point where you review prices every single year and contact them is a really good thing. Now, if you've not done that for a while with your existing clients, you may find yourself in a situation where you've got some legacy clients that are on really old rates, quite far away from what maybe you're charging now. And for those ones, that jump might be quite significant. It's not something you can put in an email. And for those, a great way to do that is just have a conversation that goes it goes exactly like this. You say, look, you're currently at these rates. If you're a new client now, you would be at these rates. How would you feel about us closing that gap? So the key question is, how would you feel? That's the key phrase. Because if they say, do you know what, we can't afford it, if it goes up even by a penny, we're going to have to call it quits. At least you have the option then to decide what you want to do. You could get rid of that client and free up some space for more profitable ones, but you might you might need that client to take you through a particularly tricky period. But by phrasing in that way, how would you feel about closing that gap? The worst that can happen is the client says, well, if you did, that would cause us issues. At least you have that knowledge. What's more likely to happen is anything between, yeah, that sounds absolutely fine, we think you're great, and we've been waiting for this call for a while, to, okay, well, how about we meet halfway, or how about we phase that up over the next 6 months? So every single person I know, like literally every person I know who's tried that has got a favorable result. So I'd encourage you, if you are daunted by it, that's a great phrase to use for existing clients. So definitely every year, and that avoids then the ones that are really far behind, having that huge gap. Now, for your prospects, what regularly increased prices means is, I believe, is to play a little game with this. Set yourself a challenge. Can you increase the price every 3 months? Because your prospects have no knowledge of what you charged previously. The price that you charge them is simply a function of your confidence in your own abilities. And I appreciate you can't fake that. You need to back up that price and back up that confidence. And there's lots of things that you can do. I've got a whole webinar on how to increase your prices that look specifically at how you can get that confidence. But imagine if every quarter you played this game of how could you sell what you did last month or last quarter for more next quarter, and just edge that up and build your confidence step by step by step. Because what happens is you'll then be bringing in clients at much higher rates than you were 6 months ago, a year ago, and it will give you the confidence to take action with those legacy clients, and you won't mind losing them because you know that you're bringing in ones at much higher rates. So that's what regularly means in my book. Every year for existing clients, but every quarter is a challenge, or even sooner, you know, if you're early stage of the business. Almost, you know, we worked with one company years ago, and they were very early stages. Almost everything they sold, they then tried to sell it the next time for more. It's a great game to play. So score yourself out of 5 for profitability. It's one of those areas we can always do more. I'd be surprised if anyone scores them 5, but you never know. Next up, we're going to look at discounting. So pricing is one thing, but if you then discount that, you are blowing all of your margin out of the water. And it makes me cry to see some of the stats around this. We've got this data for both agencies and consultancies that shows that far too many of you are giving away margin without anything in return. And we've got, you know, you go and check out the bench press reports, all of the data's in there. And, you know, discounting has its place, but only if you're going to get something in return. And there's lots of things that you can get greater return, such as, you know, introductions to other parts of the business, greater volume. If they're going to get a discount, well, maybe there's an upside for you. Okay, well, if we deliver it quicker or we get better results, then we get paid more. So it's important to have rules for discounting that your whole team follow, that maintain your margin. And by the way, those rules might be, we just don't discount. Like the fees are our fees. You know, we don't make loads of money. That's the fee to do the job properly. And there is no discounts. But if you are going to have discounts, it's really helpful to have really clear rules that your whole business can follow, that gets you more of what you want. And always think about what you're going to get in return if you are going to discount, if you really, really have to. But I'd encourage you to do it as little as possible. Again, have a think about how well you do in that area. Give yourself a score. So much of our profitability sort of leaks out because we've not scoped the project profitably at the outset. So do you go into the detail required at the outset to ensure that what you sell is scoped accurately? And at this point, listening to that question, you may well have a feeling in your stomach about, maybe it's an uncomfortable feeling that actually you could do better here, that, you know, maybe you do okay, but there's certain areas that are complex and you don't go into the detail required. There might be certain projects that have happened recently that have just got a bit messy. And actually, you probably know deep down that if you'd have spent additional time at the discovery stage, the scoping stage, that you would have got a better outcome. I know one of our clients takes this very seriously. They won't work with a client unless they create digital products or help people take digital products to market. And they won't work with a client unless they've gone through a 5-day scoping process. Literally, they sit their team down in their offices for 5 days, and they go out and they start off with a blank sheet of paper, and they finish with a fully spec'd out project. And they charge for this. They charge for this exercise, and it's pretty meaty. It's charged 25 grand for this exercise. And actually, when in looking at the number of people involved, it's not super profitable for them. But what it means is they only work with people that are serious about this. And then what comes out of it is a very, very detailed project plan that's been properly scoped. Now, you don't need to do 25 grand scoping exercises, but what is the next level for you? And, you know, if you've not cracked this, where on this score scale do you think that you sit right now? There's one thing scoping it accurately is then sticking to it, and project management plays a huge part. So right now, look, I run a service business. Many of you listening to this too, right now, our teams are working away, beavering away for us. And it's in these moments when we're working on client work that profitability leaks out through the way that we handle projects. And the question I have for you is, do you have the systems in place to handle scope creep and manage the work profitably? Now, scope creep is inevitable because the world changes, clients' ideas change, you spot opportunities, and there's so many ways that a project can go out of scope. The question is, how do you handle it? And there's a variety of ways to handle this well. Number one, have the conversation with clients up front. It's absolutely essential. So here's what 5 out of 5 look like. Number one, you're having a conversation up front and you're saying, right, how do you want us to handle things when they go out of scope? Because having that conversation 48 hours before the deadline when everyone's stressed is not going to happen. You need to have the conversation up front when everyone's calm. And then there's really only 2 options. One is that you agree a contingency budget that says, right, okay, 20% of the total project fee is a contingency budget, and when things go out of scope, we'll draw down on that. The other option is we just say, well, look, it's time and materials. So as we go through this, anything that crops out outside of scope, we'll bill you for it. Now, what you also need to agree at the outset is, well, what's the sign-off mechanism? Who can sign it off? What are their budgets? What is the process for saying, raising a flag, both internally within your business to say, things are just, this request is outside of the original scope. And then what's the process of the client ends to get that signed off to either draw down on the contingency budget or to get it signed off on a time and materials basis. But just letting that drift, not having a process in place internally and with the client, is a recipe for profitability leaking out of your business every minute of every single day. And it's happening right now for so many of us, and it need not to. So again, if you're having the conversation up front, you use contingency budgets, or you agree a process for signing off time and materials with clients, and crucially, you execute that brilliantly well in the team, you know your whole team are behind this, then you're going to score yourself a 5. If not, score yourself lower. Right, we're nearly there. Your existing customers. Quick scores time now. How well do you actively manage your accounts and maximize profits from your existing customers? 5 out of 5 looks like account plans for all your key clients, targets set for all your account managers, and those plans regularly reviewed in alliance with your clients, that you're working together with them to help identify more opportunities to expand your solution to various parts of their business. That's what active account management looks like. You know what it looks like. I'm sure you're all brilliant at it. Score yourself out of 5 for that. And then finally, this is the bit a lot of businesses fall down in terms of the leaders of the business are very clear about the importance of profitability. Often the senior management team are, but it's what goes on day to day with the people within our business that really makes the difference. And are your team aware of the importance of profit and what they can do to help achieve more of it? Because if they're not, then if you don't have that profit culture, then profit's going to leak away. So again, if you're sat there thinking, do you know what, everyone understands, they're fully behind this, there's no scope creep, and they understand the importance of profit, give yourself a 5. If you're sat there thinking, this is a lonely pursuit, it's only really me that's focused on this, then you score yourself low. But give yourself a score. And then finally, you're going to get this, which is your finance and profit audit score. And you will see that for each section, so infrastructure, reporting and profitability, you get an individual score, you get a total score in the middle, and you can see a tick sheet at how well you're doing against each one. Now, if you're sat there thinking, I'd love to get a higher score here, then this is what you need to do. There's a link to Rory's diary. Rory is someone who works with me and Dan, and Rory would love to chat to you about how we can get you to 100%, or at least increase your score in a particular area. So if you sat there thinking, well, maybe I need to change my accountant and speak to someone who can help me up my game here, then there's a link to Rory's diary. That's something that you can do as an action from today. This has been emailed to you, so you've got time to go through it yourself and look at where you need to improve. But that's the key question, is where do you want to improve as a result of today?